welcome to the Deep Dive. Today, we're doing what we do best, taking what looks like a dry corporate history, just a stack of source material in an energy company, and we're going to turn it into a story.
And it really is a story. It's a narrative about, ambition, about some serious financial innovation, and just relentless empire building.
Absolutely. And with that comes high-stakes risk. Our mission today is to give you the shortcut, the real story of how a, $250,000 Midwestern startup became one of the biggest energy players on the planet.
And this is exactly the kind of company history that, on the surface, just looks like a boring list of dates and acquisitions. But when you dig in, you see this really relentless 3-decade campaign of strategic moves.
So who are we talking about today?
We are diving deep into Apache Corporation. Now, that's the big umbrella holding company for the name most people would probably recognize, which is Apache Corporation.
And what's their business?
They are a pure-play American energy powerhouse. They're focused exclusively on hydrocarbon exploration and production.
So, in simple terms, getting oil and gas out of the ground.
That's it. And when we talk about the scale here, you have to understand they've moved so far beyond those origins. This is not some regional player.
No, not at all. APA is a heavyweight public company. It trades on the NASDAQ. And importantly, it's a key component of the S&P 500 index.
And that right there, the S&P 500 tag, it tells you everything you need to know about its importance. The health of this company, its ups and downs, are woven into the American economy and, frankly, the global energy supply chain.
Okay, so let's put some numbers on that scale to ground this for everyone. What are we looking at for, say, 2024?
The financials from 2024 are pretty staggering. You've got revenue closing in on $10 billion, specifically $9.74 billion.
Almost $10 billion in revenue.
And profit.
Net income was solid. It came in at $804 million.
Yeah.
But, in this business, it's not just about the money.
Right. It's about the physical product. How much are they actually pulling out of the ground? That's the real measure. And their output is, it's immense. Daily production is consistently around 500,000 barrels of oil equivalent per day.
500,000 barrels every single day.
The latest number is 454.7 thousand barrels of oil equivalent, to be precise. And that kind of flow, you have to imagine the sheer scale of the infrastructure needed just to sustain that.
All of which, the rigs, the pipelines, the reserves themselves, that adds up to a huge asset base.
It does. Total assets are sitting just shy of $20 billion, $19.4 billion.
Okay, so that's the snapshot today, a nearly $20 billion company.
Right. And when we start this story by telling you it all began with just $250,000 in initial funding, that contrast should really hook you.
It's an incredible arc.
And that's what our deep dive is going to track. We're going to go from that humble Minneapolis startup in 1954 through a landmark financial innovation they created that reshaped the entire industry.
Then into that massive global acquisition spree that took them everywhere: Egypt, Australia, the North Sea.
And finally, we have to look at the big missteps, the $3 billion failures, and of course, the critical environmental and operational controversies that really define their risk profile today.
Okay, let's unpack this. Start the clock. Back to the 1950s, in a place you would never expect a global energy giant to be born. The story of what was then called Apache Oil Corporation. It doesn't start in the Texas oil fields, not in Houston.
No, not at all. It starts in, of all places, Minneapolis, Minnesota. The company was officially founded on December 6, 1954.
That Midwestern origin is it's a fascinating piece of the story. It shows you that the energy world wasn't always so concentrated in one place.
Exactly. The three founders were Truman Anderson, Raymond Plank, and Charles Arnow. And again, that initial seed money, $250,000. This was a classic venture built on hustle and opportunity, not some huge corporate backing.
And they didn't waste any time.
No, they moved fast. Their first real operations started almost immediately in 1955, and they were smart about it. They didn't go out into the middle of nowhere trying to find a new field.
They weren't wildcatting.
No. They went straight to work drilling wells in an established area, the Cushing Field, which is right between Tulsa and Oklahoma City.
So a low-risk entry strategy.
The lowest risk. You go to a place where you know there's oil. It was all about generating immediate cash flow, proving they could actually do the work. They had to build credibility one well at a time before they could take on the bigger risks.
And that methodical approach, it paid off.
Yeah.
But it took a while to get their first big hit, right?
It did. Their first really major discovery, the kind of strike that proves you can find new oil, didn't happen until 1967. That was the Fagerness #1 oil well.
And that discovery gave them the momentum they needed to go public.
Exactly. Just 2 years later, in 1969, they were a publicly traded company. Think about that path from $250,000 and a low-risk strategy in Cushing to a public company in just 15 years. It really shows you the ambition they had from day one.
And that ambition was kind of physically represented in their headquarters, wasn't it?
Oh, absolutely. From the early 1960s all the way until 1984, their HQ was maybe the most famous landmark in Minneapolis. The 32-story Fauché Tower.
I love this detail. The tower is basically a half-scale imitation of the Washington Monument.
Right. I mean, can you imagine running your growing oil company from a building that just screams permanence and national ambition? It's such a public statement of intent, even when they were miles away from the real energy centers.
But their focus wasn't always 100% on oil and gas. There was this strange little detour in the 70s.
The agricultural detour, yeah, it is a bit of a whimsical sidetrack. They diversified by buying the S&J Ranch out in California.
So for almost 2 decades, they were both an oil company and a farm.
A big one. From 1970 to 1987, they were producing citrus, figs, olives, pistachios, almonds, you name it. It was part of that corporate trend at the time to build these broad conglomerates, to hedge against the volatility of one market.
But running an olive farm and an oil rig, that seems like a massive operational split. Why did they eventually sell the ranch?
Well, that's the key question, isn't it? Ultimately, managing crop cycles and managing oil reservoir depletion are two very, very different skill sets. It became a distraction.
So they decided to refocus.
They made a definitive choice in 1977. They sold the ranch, sold all their other non-petroleum assets, and took all that capital and poured it right back into the core business.
And where did that money go specifically?
It went into a really strategic opportunity. It was something called a farm-in agreement with a company called GHK in the Anadarko Basin.
Okay, farm-in agreement. Let's pause on that jargon. What does that actually mean for a company like Apache?
It's a fundamental concept in the industry. So say an owner of a lease, like GHK, has a promising piece of land, but maybe they don't have the cash or the risk appetite to drill it themselves.
So Apache comes in.
Apache farms in. They agree to take on all the operational responsibility, they pay for the drilling, they take on the risk, and in exchange, they get a share of any oil they find, and critically, a share of the ownership of the land itself.
So they were using the money from their literal farm to finance a figurative farm-in.
Exactly. It was a perfect example of strategic clarity. They were getting back to their core competency, financed by selling off the assets that didn't fit. And that move really set the stage for their biggest innovation.
And this innovation, it wasn't about drilling technology. It was about money.
It was about capital structure. In 1981, they created something called the Apache Petroleum Company, or APC.
And why is APC such a landmark moment in American business history?
Because APC was the very first public master limited partnership, an MLP, in the United States. This structure, which Apache basically invented, completely reshaped how the energy and infrastructure sectors financed themselves for decades.
Okay, so an MLP is publicly traded, but what's the fundamental difference between that and a regular corporation, like a C Corp?
It all comes down to taxes. A normal corporation pays corporate income tax on its profits. Then, when it pays dividends to shareholders, the shareholders pay income tax on those dividends.
That's the famous double taxation.
Right. An MLP avoids that. It's treated like a partnership for tax purposes. The income, the deductions, all of it passes directly through to the investors, the unitholders, who only pay tax once at their individual level.
Which is a massive advantage in a capital-heavy industry like oil and gas.
A huge advantage. It allowed companies with big infrastructure costs, pipelines, rigs, real estate, to raise massive amounts of public capital much more efficiently, without the drag of corporate taxes. Apache pioneered this. It was a financial masterstroke that gave them the firepower for the expansion that was about to come.
But that expansion meant they couldn't stay in that symbolic Fauché Tower forever. The next decade was really defined by a migration, a move toward the industry's center of gravity.
Yeah, that migration really shows their growing scale and ambition. The first move was from Minneapolis to Denver in 1987. Denver has always been a key hub for the industry, especially for anything in the Rockies.
But that was just a stopover. 5 years later, they made the big definitive move.
In 1992, they moved the headquarters permanently to Houston, Texas, specifically to Post Oak Central. And this wasn't just a small office. They signed a lease for 220,000 square feet.
So the move to Houston, that's the capstone of this whole early era.
It's everything. It's plugging into the global talent pool of geologists and engineers. It's accessing the densest network of banks and capital. It's being next door to your partners, your service companies, the supermajors. It was a declaration that Apache was done being a regional player. They were ready to become a global acquisition machine.
And they had all the pieces in place. The MLP for capital, a focused strategy, and a new home in the heart of the industry. The stage was perfectly set for an explosion of growth.
The 30 years after the mid-'80s, I mean, you can define it almost entirely by one strategy, growth by acquisition. They just went on a relentless buying spree.
They weren't growing by finding new oil fields so much as they were growing by buying existing ones.
Exactly. They mastered consolidation. It started pretty modestly, testing the waters. In '85, they bought wells across 8 states from a company called David Holdings for $200 million. A year later, they grabbed assets in the Gulf of Mexico from Occidental Petroleum.
Smart, tactical moves. But the real game changer, the deal that really set their DNA for the future, was in 1991, the Amoco deal.
Oh, this one is absolutely critical. It's one of the most consequential deals in their history. They bought a package of assets for $515 million, plus they gave Amoco 2 million shares of Apache stock.
And the impact was immediate.
It was stunning. The deal doubled the company's reserves overnight.
Doubling your reserves in a single transaction,
Yeah.
that just catapults you into a completely different league. But it wasn't just about the volume, was it? It was about where those reserves were.
That's the most important part. This Amoco deal gave Apache its first major position in the Permian Basin of West Texas.
And making that move in 1991. That's decades before the shale boom made the Permian the center of the oil universe.
It shows incredible foresight. They secured a critical foothold in a region that would become the absolute king of U.S. oil production. That one deal in 1991 basically ensured they would be central to the American energy story for the next 30 years.
So with their domestic position solidified, they started looking outward. By the mid-90s, they were ready to go global.
And the global leap was incredibly fast and geographically diverse. They landed in 2 totally different energy hubs at almost the same time. Australia and Egypt.
Yeah, let's start with Australia, 1993.
They bought a company called Hudson Energy Resources for about $58 million. That gave them offshore assets in Western Australia. Suddenly, they had a toehold in the Asia-Pacific.
And at the same time, they moved into Canada.
Yep. In 1995, they acquired DeKalb Energy Canada. So within just a couple of years, they've gone from being a U.S. company to having operations across North America and Australia.
But in 1994, that's the year they made their deepest, most long-running international bet. And that was Egypt.
The move into Egypt was, again, very strategic. They started small, low risk. They bought a 25% non-operated interest in the Corinne concession.
So they weren't running the show at first. They were just a partner.
Right, an investor. But production started up very quickly by December of '95. And then just a year later, they took the big step. They acquired the main operator, Phoenix Resources, and took over the whole thing.
What was it about Egypt, and specifically the Western Desert, that was so appealing to them as a long-term anchor?
A few things. First, the oil fields there, while remote, are what you'd call prolific and relatively simple to develop. It's not like super complex deep water stuff. Second, Egypt has generally been a very reliable partner for U.S. energy companies.
Third,
It played right into their strengths. They were experts at taking over mature fields and optimizing them, squeezing every last drop of value out. It was a perfect fit, and it laid the foundation for a commitment that's lasted 3 decades.
okay, so that brings us to the late 90s and 2000s, which you called the era of the mega deal. This is when they started buying assets from the supermajors.
This was their signature move. When we say supermajors, we mean the absolute giants: Shell, Exxon, BP, Chevron. These companies operate at such an immense scale.
Right, so a field that's producing, say, 50,000 barrels a day is huge for a company like Apache.
It's transformative for Apache, but for ExxonMobil, it's a rounding error. It barely moves their needle. The supermajors often see these mature, aging assets as non-core. They take a lot of work to maintain for what, to them, is a small return.
So Apache's strategy was to be the go-to buyer for what the giants considered their leftovers.
Precisely. They could buy them at a good price, apply their focused operational expertise, and make those assets the absolute centerpiece of their own portfolio. And you see the pattern over and over.
Give us an example.
1999. They buy a bunch of fields in the Gulf of Mexico from Royal Dutch Shell for $715 million plus stock. Shell was cleaning house. Apache was building an empire.
And they kept building in Egypt, too.
Oh, yeah. In 2001, they bought Repsol's operations in the Libyan desert for $410 million. This was all about density buying up neighboring fields, consolidating infrastructure, becoming more efficient.
But the most eye-popping deal from this era, the one that really highlights the strategy, was the 2003 deal with BP.
Yes, the Forties oil field. In 2003, they bought the Forties field and some other Gulf of Mexico assets from BP for $1.3 billion. And we have to stop and appreciate the Forties field. This was the largest oil field ever discovered in the entire UK North Sea. It's a legend in the industry.
Wait a second. If it was the biggest discovery in the North Sea, why on earth would BP sell it, even for $1.3 billion? It sounds like selling the crown jewels.
It does, but you have to think like a supermajor. By 2003, the Forties field was old, it was past its peak, and managing its decline requires a ton of money and work in a very high-cost place like the North Sea.
So BP could take that $1.3 billion.
And redeploy it into some massive new frontier exploration project that could actually move their multi-hundred-billion-dollar needle. For Apache, though, that $1.3 billion bought them a historic, cash-flowing asset that immediately made them a major player in Europe's most important energy basin. It was a brilliant move.
So beyond the big buys, they were also having their own exploration successes.
They were. On the technical side, in 2002, they drilled their first deepwater wells offshore Egypt. That showed they could handle the more complex, expensive stuff.
And Australia was a big success story, too.
The Van Gogh project, yeah. In 2007, a test well there produced almost 10,000 barrels a day, just a huge flow rate. That validated the whole project, and it went into full production in 2010.
But even as they were buying all this stuff, they were also constantly selling. It seems like they were always optimizing the portfolio.
That's the mark of a sophisticated operator. You're always pruning. In 2005, they sold their deepwater Egyptian stake to Hess. Maybe they decided deepwater was too risky for them. In 2006, they got out of China.
And that trend really accelerated later on. They sold all their Australian assets in 2015.
For a cool $2.1 billion. And then they exited Canada completely in 2017. You see the life cycle, right?
Buy in the 90s, operate for a couple of decades, extract the value.
And then when the price is right or the area no longer fits your core strategy, you sell the whole package and reinvest that cash into what really matters, which for them was increasingly the U.S. Permian and their rock-solid Egyptian operations.
And that focus on the core really sets us up for the 2010s, where they just kept buying at an incredible pace.
The early 2010s were it was a massive growth period for them. The buying sprees were almost dizzying.
Just in 2010, they bought 2 big packages of assets in the Gulf of Mexico.
Yeah, over $3.7 billion in 1 year in the Gulf alone, $1 billion from Devon Energy, and then they bought a company called Mariner Energy for $2.7 billion. They were just vacuuming up production in their backyard.
And they kept their hand in the North Sea, too, buying from ExxonMobil in 2012.
Right, the Beryl field. But the deal in 2010 that everyone remembers, the one that grabbed all the headlines, came after one of the worst industrial disasters in modern history.
Here's where it gets really interesting. We're talking about the aftermath of the Deepwater Horizon spill.
Exactly. The tragedy put BP in an impossible financial position. They were forced to sell off billions in high-quality assets around the world just to cover their liabilities. It was a fire sale.
And Apache stepped in.
With a $7 billion check. They bought a massive package of assets from BP covering Texas, New Mexico, Western Canada, and Egypt.
That is an incredibly aggressive, opportunistic move. What does that tell you about Apache's position at the time?
It tells you they were swimming in capital and had an enormous appetite for risk. They were confident they could manage those assets, even under the intense scrutiny the industry was facing. I mean, it strengthened all 3 of their core areas in one single transaction. It was probably the biggest opportunistic expansion in their entire history.
And domestically, they kept getting bigger. The Cordillera acquisition in 2012.
Another big one. $2.5 billion in cash and stock. This was all about regional dominance. It added 71 million barrels of oil equivalent to their reserves and just cemented their control over western Oklahoma and the Texas Panhandle. Pure U.S. onshore consolidation.
But after all this success buying proven assets, they pivoted back to high-risk exploration. And that's where we find the big stumble. The cautionary tale of Alpine High.
Alpine High, yes. This is absolutely essential to understanding their recent history because it was a monumental strategic failure.
So what was it supposed to be?
In 2016, they announced this massive new discovery in a totally unproven area of the Permian called Alpine High. The hype was off the charts. They thought this was it, a play that would give them decades of growth without having to buy anything ever again.
And how much money did they pour into this supposed game changer?
More than $3 billion. I mean, $3 billion in exploration, drilling, building pipelines, processing plants, everything you need to develop a new area from scratch.
But the excitement didn't last. What went wrong?
The rocks, basically. The geology was just way more complex and way less consistent than their models predicted. The wells didn't produce the volumes they expected, and the gas they did find was difficult. It was wetter and had more contaminants than they anticipated, which made it super expensive to process.
So by 2020, they had to admit it was a failure.
They had to write off the vast majority of that $3 billion investment. An enormous, painful write-off.
And what were the internal consequences of a failure that public and that expensive?
They were swift. Stephen Keenan, the VP of Global Exploration, the guy who was the lead geologist championing the play, he resigned in 2019, even before the full write-down.
It was more than just a financial loss then.
It was a strategic rebuke. It was the market and their own balance sheet telling them to stop the high-risk wildcatting and get back to what they do best. Disciplined acquisition of proven fields. It was a very powerful, very expensive lesson.
Okay, so let's pivot from that learning experience to the present day. If we look at their operations now, how does the map reflect that history?
Yeah.
Let's use the 2021 reserve data.
The 2021 data paints a really clear picture of a company that is refocused. Total reserves were about 912 million barrels of oil equivalent. But the concentration is what's key. 68% of that is in the United States.
So 2/3 of their future is anchored in the U.S.
Exactly. 20% is in Egypt, and the last 12% is in the North Sea. So it's still a global player, but a very focused one.
And within the U.S., where is that 2/3 concentrated?
It's almost all in the Permian Basin. I mean, that is the ultimate vindication of that deal they made way back in 1991. The Permian is the engine.
And then you have that Egyptian anchor, 30 years in the Libyan desert. The source material notes something astonishing, that they haven't had any major disruptions from all the political turmoil in the region.
That detail right there is probably the best sign of how sophisticated they are as an operator. To keep production stable for 30 years through revolutions and coups, that takes incredible risk management.
It has to be more than just luck.
It's about having robust agreements with the state energy company. It's about sophisticated local security. And it's about making sure your operations are a source of stability and employment for the country. You make yourself a valued partner no matter who is in charge. It's a massive strategic asset for them.
Now, speaking of structure, in 2021, we saw them legally restructure, with APA Corporation becoming the holding company. What does that mean in practical terms?
It's more than just a name change. Apache Corporation, the operating company, became a subsidiary of the new parent, APA Corporation.
And why do that?
It creates a cleaner legal firewall. It helps you manage liability by isolating risks in different entities. And it gives you a more flexible framework for future acquisitions or divestments without messing up the whole corporate structure. It's a move toward more centralized strategic governance.
And fast forwarding to today, that acquisition engine is clearly still running. We have to talk about the latest mega deal from January 2024.
The Callon Petroleum acquisition. This deal tells you everything about their current strategy. It was valued at about $4.5 billion, including debt.
And it was an all-stock transaction. Why is that detail important?
Because it means they didn't have to drain their cash reserves. They used their own equity as currency to buy Callon. It's a financially conservative way to get bigger while keeping your cash for operations.
And what do they get with Callon?
More Permian. Callon's assets are primarily in the Permian Basin. This was a pure play, doubling down on their core U.S. asset base. It was the ultimate proof that the lesson from Alpine High was learned. Stick to what you know. Consolidate in your core area. But, operating at this scale across 3 continents for so long, that history is absolutely intertwined with some major controversies and complications.
Right. When a company grows this fast and gets this big, you have to look at the external costs,
Yeah.
the environmental and operational risks. Let's start with a major environmental disaster, the huge toxic spill in northern Alberta, Canada, back in 2013.
This happened on June 1st, 2013. A pipeline at their Zama field operations ruptured, and the scale was it was catastrophic. It spilled 60,000 barrels of toxic waste.
60,000 barrels. Let's try to put that in perspective. How much is that?
It's 9.5 million liters of contaminated water and chemicals just released directly into the environment.
And the sources call this one of the largest such disasters in recent North American history. What was the immediate impact?
Devastating for the local ecosystem. I mean, ecologists said it would just kill the plants, impact the water table, and even though the area was remote, the sheer volume meant a massive multi-year cleanup effort. It immediately raised questions about the integrity of their pipelines and their oversight.
It's a stark reminder that every barrel of oil produced comes with a liability risk.
A risk that can materialize in an instant and at an enormous cost.
Okay, so from an environmental catastrophe, let's move to a major operational failure, one that crippled an entire regional economy. I'm talking about the 2008 pipeline explosion on Varanus Island in Western Australia.
Yeah, this incident is a perfect case study in how one failure can cause a systemic crisis. Varanus Island was a critical hub for processing natural gas for Western Australia. When that pipeline exploded in June of 2008, the supply was just cut off instantly.
And what did that mean for the region? What was the Western Australian gas crisis?
It meant economic paralysis. Western Australia's economy, especially its huge mining sector, runs on natural gas for electricity and industrial power.
So when the gas stopped?
Everything stopped. Mines had to shut down, heavy manufacturing went dark, power plants were starved of fuel. It caused hundreds of millions of dollars in economic damage and exposed just how fragile the whole energy system was. And it all traced back to that one failure at Apache's facility.
And the legal aftermath is also telling, isn't it, in terms of corporate accountability?
Absolutely. The Australian government understandably went after the company, pursuing charges for the failure. But in the end, they were forced to drop the charges because of a legal technicality.
A technicality.
Yeah.
After causing a statewide economic crisis.
Right. And it raises that critical question. When a corporate failure has such massive public consequences, but a legal loophole prevents prosecution, is the system really working? It just highlights the gap that can exist between operational responsibility and actual legal accountability.
So beyond the physical risks, we also see a pattern in their corporate governance, specifically around shareholder rights.
This is a really revealing part of their history. The CEO at the time, G. Stephen Ferris, was very active in trying to limit the influence of shareholders. In 2007, he actually wrote to the SEC arguing for limits on what are called non-binding shareholder proposals.
Okay, help us understand that. Why would management fight proposals that are, by definition, non-binding? They're just suggestions, right?
They are, but they're a powerful tool for investor activism. If shareholders pass a proposal, even a non-binding one, say, asking the company to report on its climate risks, it forces management to publicly respond. It puts pressure on them.
It signals that the owners are unhappy.
Exactly. So by trying to limit these proposals, the CEO was essentially trying to build a shield to minimize public pressure and allow management to keep pursuing its aggressive strategy without, constant nagging from activist investors.
And we saw that desire for control play out in court, too.
We did. In 2010, Apache successfully blocked a corporate governance proposal from even being voted on at their annual meeting. And the court sided with them.
On what grounds?
On a technicality. The person who submitted it failed to prove, according to the very specific SEC rules, that they had been a shareholder for the required amount of time. They used the fine print of corporate law to control the agenda.
So when you put the 2007 letter and the 2010 court case together,
you get a very clear picture. A highly ambitious, growth-focused company that wanted to consolidate power in the executive suite and ensure that any challenges to their strategy were minimized through proactive legal and regulatory moves.
So what does this all tell us? This mix of incredible success, massive failure, and these controversies. What's the DNA of this company?
I think it tells us they are masters of two things. One, financial strategy. You see that from the MLP to the opportunistic buying. And two, operational execution. You see that in their 30 years of stability in Egypt. But their history also has this heavy shadow. They've generated huge environmental liabilities, caused regional crises, and actively worked to insulate themselves from investor dissent. Success at this scale, it seems, comes with very proportional risks.
Okay, let's try to wrap this all up. Let's synthesize this incredible journey.
When you look at the whole arc of Apache Corporation, you see this transformation from a pretty modest Minneapolis startup that was distinguished early on by this incredible financial innovation, the MLP, that really set the stage.
Right, that MLP gave them the capital advantage they needed for the decades of expansion that followed. capital that funded a trajectory just defined by continuous strategic buying.
And they mastered that art of buying the proven, mature assets, the crown jewels, really, from super majors like BP and Shell. They built this global structure anchored in three key places.
The Permian Basin, the stable fields in Egypt's Western Desert, and the high-quality assets in the North Sea. That focus is what turned them into a $19 billion company.
And their story is really a masterclass in portfolio management. They were constantly optimizing, right? Shedding places like China, Canada, Australia to reinvest that money back into the Permian, all while showing this incredible resilience in a high-risk place like Egypt.
But that success story, as we've discussed, is permanently marked by the $3 billion failure of Alpine High.
And by the massive toxic spill in Canada in 2013 and the pipeline explosion in 2008 that caused an economic crisis across an entire state in Australia.
So the history of Apache Corporation is, in a way, it's the modern textbook on how to scale an oil and gas company. But the key lesson for you, the listener, is that achieving that kind of scale across 3 continents, well, it's inseparable from its major environmental and safety incidents and its efforts to control its own governance.
And that brings us to our final provocative thought for you to take away. Given this irreversible global push towards an energy transition, and at the same time, considering APA's recent, very clear commitment to high-volume oil production, which is underscored by that $4.5 billion acquisition of Callon Petroleum.
A deal that does nothing but reinforce their position in the Permian.
Exactly. So the question is, how will this company over the next decade financially justify and operationally balance the demands of continued high-volume hydrocarbon production with the rising global pressure for climate responsibility and much tighter environmental regulations?
That tension between the financial need for high production today and the long-term liability of climate risk tomorrow, that's the challenge that's going to define not just APA, but every major energy company moving forward. We thank you for deep diving with us today.